Alright, welcome to the last part of Chapter 5. It's a long road, but we made it. We sure have learned a lot, especially when it comes to retirement and the IRAs and the self-employment, to different types of itemized deductions that we have in the breakdown of Schedule A. Now we're going to find out the last little part, which basically is what we have to fill in, of other itemized deductions. And the big one that we have is casualty and theft losses. Now, these deductions may be either itemized deductions or deductions for AGI if it's business related. Now, it used to be we can do it for any personal time that we got something stolen or destroyed. But the IRS has now pinpointed that it has to be resulting from an identifiable event of a sudden, unexpected, and of unusual nature. Basically, if we get to be declared as a federal declared disaster area. Once FEMA or any of those come out to play, and the president says that it's a federal declared disaster area, we get to take casualty loss. So again, that's from any kind of storms, floods, fires, and vandalism. Now, theft losses are deductible if taxpayer can prove theft has occurred, which would be the police report, anything. Casualty losses are deductible in year of occurrence except for that federal declared disaster losses. Those losses are deductible in the year theft is discovered. Okay, so for example, the 2021 winter storm is actually going to be happening for 2020 taxes. Per Marvel, but not per Marvel, per the government. I don't know why I said Marvel. Anyway, if you can't tell, I'm a little bit tired when I'm doing this video. But with theft, it is deductible in the year that it is discovered. So how do we measure the loss? Well, for casualty or theft losses, it's measured by one of two of the following rules. Rule A. The deduction is based on the decrease in fair market value of the property not to exceed the adjusted base of the property. Okay? This applies to partially destruction of businesses or investment property and partial or complete destruction of personal property. Or we can take Rule B. In Rule B, the deduction is based on the adjusted basis of the property. Applies to the complete destruction of the business and applied property. Again, some people will take B just because they want to take B because it's the adjusted basis. How much did it lower? Diminished value. Well, to me, Rule A also typically is used a lot too. I think it's actually used more because people like the fair market value. Now the deduction limits. A new TCJ that law suspended the allowable loss for personal casualty losses except when it's again a federal declared disaster. That's the TCJA for you. Such losses are subject to a $100 floor per casualty and must exceed 10% of your AGI to be deducted. So again, a little bit of limits right there. Something that we also lost with the TCJA, called miscellaneous expenses, are basically the 2% rule. So, two types of miscellaneous itemized deductions: those subject to the 2% rule and those that are not. The most common deduction subjected to the 2% rule, and that's basically 2% over AGI, unreimbursed employee business expenses and employee expenses reimbursed under a non-accountable plan. That was one that we could really use when you don't have a Schedule C, and people could at least try to deduct some of the business expenses that occur. Investment expenses was another big one that's no longer there unless you have a Schedule C. Pretty much doesn't help. And other miscellaneous expenses, including the all-important tax preparation fees. Yes, we used to be able to deduct tax fees as an itemized deduction. No longer can we do that. Just doesn't work. Now the TCJA suspended the deduction of all miscellaneous item deductions subject to the 2% rule, and those right there, they're coming back. I think it's only for a few years, and then we should see it back unless Congress decides to extend. Now, miscellaneous item deductions that are not subject to the 2% floor are not affected. This includes a real big one in gambling. We can do gambling. So, and they actually do not show gambling. Oh, there it is, gambling losses. And they do have it where gambling losses is to the extent of your gambling income. Basically, whatever you won, you can take losses up to that if you do have that. Most likely you do, unless you won the $1 billion prize. Then that may be a little bit tougher to expense out. But prior to 2018, again, certain high-income taxpayers were subject to limits of the amount of itemized deductions. Again, a little bit of phase-out. So certain AGI limits for different filing status triggered a reduction in itemized deductions by the lesser of either 3% of the excess of taxpayers' AGI over the threshold amount, or 80% of itemized deductions. Again, you can see it's excluding deductions for medical, interest, casualty and theft, and gambling losses. The TCJA has suspended this phase out, which is nice. Okay, so leaving a nice note for TCJA, even though they cost us the 2% miscellaneous, especially for employees. And we're going to close it out that this is the end of Chapter 5. Again, one more look at the last itemized. So right here is other itemized deductions, where we list what we can and take our amount, and of course we'll find out our total deductions. But again, it's our choice if we want to take itemized or standard. Again, most people and most clients will take the higher of the two. Just means more deductions. But this will again conclude Chapter 5. I will see y'all next time for our next chapter. And again, let me know if you have any questions whatsoever.